This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be providing you with a portfolio update on my Sharesies public portfolio for the month of March 2021. As well as that, I'll be going over Oceania Healthcare's equity raise. They are raising money from shareholders to buy a retirement village land and to have more cash on their balance sheet. So I'll be talking about the offer later on because the offer for retail investors or people like you and me is still opened until the 12th of April 2021. So we still have some time left to consider whether or not we want to participate. So I'll be going over that offer. And with no time wasted, let's get right into the video. So here is the portfolio update. I'm recording this on the 1st of April 2021 at 9:56 before market open. So this will reflect the portfolio values as at the 31st of March 2021. So the current portfolio value is $15,963. And I also have $136.44 available to invest. And I've left the money there on purpose and not invested it to participate in Oceania Healthcare's retail offer for the share purchase plan. So basically under the retail offer, if you owned Oceania Healthcare shares before a certain date, then you'll be able to participate in the purchase. But if you were on Sharesies as well, you would have received an email last week asking you to express your interest in buying Oceania shares at $1.30, and that is part of the institutional offer because Sharesies as a whole is an institution and they're buying it on behalf of the client. So that's actually a really neat perk of being a Sharesies user, and that is being able to participate in share purchase plans for shares that you don't really own because Sharesies is an institution, so they'll be able to participate in the institutional offer. Hopefully going forward it will be the same, and definitely if you haven't signed up with Sharesies already, be sure to use my referral link down below. If you use the link down below, you and I will get $5, so that would greatly support the channel and would help you get started investing. So the current portfolio return is 18.09% or a total return of $2,462. And as you can see, over the past month, there hasn't been much movement actually. There was a slight dip in early March, but then I topped up the account because every week I top up money into the account based on subs as well as my weekly contribution. That is the portfolio. Nothing much has really changed in terms of the stocks that I hold. Argosy Property, Auckland International Airport, Heartland Group Holdings, Infratil, Mainfreight, NZX, Oceania Healthcare. And we have reached a point where all of the individual stocks are above $1,000. Not that it really matters, but it is nice to see the portfolio grow because if you look back into episode 1, the portfolio started out with only $1,000. What that meant was individual stocks actually only had a few $100s invested into them, and in some cases, in most cases actually, the positions that I held were less than $100. So it's very nice to see this portfolio grow from something so small to something that is decent, I think, for most people based on consistent investing. So the strategy for this portfolio hasn't really changed. I'm continuing to add more money into stocks that pay a consistent dividend or stocks that I expect to pay a consistent dividend into the future, as well as broad-based market ETFs, such as Smart Shares ASX 200, Smart Shares Australian Midcap Fund, Emerging Markets Fund, NZ Top 50, but I don't really add to this position anymore, as well as the US 500 Fund. So this portfolio is a dividend portfolio after all, so it hasn't actually moved that much despite the market volatility that we've seen, especially in the US. You know, the NASDAQ has been going up and down, but this portfolio has been relatively stable. To see the allocations of how each stock moves, let's now take a look in my Excel spreadsheet. So here is the portfolio allocation for the public portfolio, and as you can see, Oceania Healthcare still makes up the largest allocation in the portfolio at 14.4%. This is down 1.1% from the prior month. So if we go back, the allocation was 15.5% last month and the share price was $1.45, but since then we've seen the share price for Oceania Healthcare drop to $1.29, and a lot of that was on the back of the announcement that they were raising equity. The reason why the share price of a company usually drops after an announcement of an equity raise is because there'll be more shares now outside outstanding in the market, so more shares available means a lower price. So that's why the Oceania Healthcare share price is $1.29, and that's the only loss in the portfolio at 6.6%. Everything else in the portfolio is green but Oceania Healthcare, and it also has to be my largest position, but I'm not too worried. This is just a small fluctuation, and in the grand scheme of things, it just means I get to buy more at a lower price. So that's Oceania Healthcare. The second position is Heartland Group Holdings at 12.1%. Now that is down 1%. And the reason is very similar. They didn't have an equity raise, but the share price did drop from $1.89 to $1.77. In terms of the ETF holdings, across the board, all the ETF holdings had a change of 1.2%. So I did add a little bit more into my ETF positions this month, but the remaining shares didn't have much change. As you can see, Infertil negative 0.2%, NZX 0.7%, Auckland International Airport up 0.1%, and offset by Agosi Property down 0.1%, Mainfreight up 0.5%, and no change in the NZ Top 50 fund. So adding all of that up, that's a change of roughly 1%. So in the grand scheme of things, month to month, there hasn't been any significant changes in terms of portfolio allocation. And you can see that the portfolio at market is up roughly $1,000 from last month, and the majority of the increase in the portfolio value is because I have been contributing towards the portfolio. And we can also see that the dividends received over here is $186.45. So that is the total dividends received since inception of the portfolio, and that is actually higher than last month dividend received of $120 roughly. A lot of the companies in the portfolio did announce and did pay out dividends this month. So that is a good sign. This is a dividend portfolio, so we want to see this dividend portfolio grow its dividends over time. So now let's discuss the details of Oceania Healthcare's equity raise and what I'm personally doing. So to give you a high-level view of the offering, Oceania Healthcare is raising $100 million worth of equity, $80 million of which is from institutions, so Sharesies was part of that institutions group, and $20 million will be raised from retail investors. So if you owned Oceania Healthcare in your portfolio before the 23rd of March, then you'll be eligible to participate in this equity raise. Of the $100 million, $60 million will be used to acquire Waterford on Hobsonville Point. This is a retirement home, and Oceania Healthcare is actually buying this retirement home at a 3% discount to the 31st March 2020 CBRE valuation. So as you know, the Rona has caused a lot of the retirement village operators to be more conservative in their growth rates going forward, and so the fair value of these properties were a bit depressed at the time. So it's actually quite surprising to see how Oceania was able to actually buy the retirement village at a 3% discount on the 31st March 2020 CBRE valuation. This could actually mean two things. Firstly, it could mean that Oceania got a good deal, but secondly, it could also show how the current property market isn't as strong as people perceive it to be in the residential property area. So we've seen property prices go up since Rona. Property prices are up roughly 15%. But when you buy a new retirement village, it should actually reflect market values, but at the moment they're selling at a 3% discount. So maybe the property market isn't as strong as it looks. All right, so that's just my opinion. Don't sue me. Of the $100 million, $17 million will be used to buy a piece of Pukekohe land. So this is a land near an existing village that they'll try to develop. And the remaining amount is $21 million net of fees of $2 million. So it did cost them $2 million to raise $100 million. So whatever's left is $21 million, and that will be used to pursue growth opportunities. So that's what the funds are going to be used for. If you are able to participate in the offer price is the lower of $1.30 or 2.5% discount on the 5-day VWAP price on closing of offer. So the closing of the offer is on the 12th of April, and the 5-day VWAP price is basically the volume weighted average price. So you take the 5 days where the stock market is open before the closing date, and then you take the average, and that is roughly the price that you'll pay, and you minus a 2.5% discount. So if the share price drops below $1.30, say the VWAP price ends up being $1.20, then you take 2.5% discount on that. So it'll be roughly $1.17, $1.18. All right. So it really depends on how the stock price of Oceania Healthcare moves. That depends on what type of price that you'll have to pay. Now, in terms of the size of the offering, it's actually not that big. All right, because the portfolio that they're acquiring at Waterford on Hobsonville Point is less than 10% of the existing retirement village portfolio. So in other words, this deal is a relatively small offer, and the current market cap for Oceania Healthcare is close to $900 million. So raising $100 million is roughly 10% of the market cap. And lastly, the acquisition is expected to be low to mid-single digit EPS accretive. So basically, when you are considering participating in any equity raising, when the company wants to buy a new business or buy assets, you have to look out for EPS accretive. Basically, what that means is that after the share dilution, after issuing more shares, does the earnings per share of the company go up? So if it does go up, that is good. If it doesn't go up, that's bad, because you've basically issued more shares, but the company isn't generating more money on a per share basis. So low to mid single digit EPS accretive isn't spectacular, but it's not bad either. At least it's not zero, but it does mean that there's a very low margin of safety potentially that it turns out not to be EPS accretive. So if they said low teens, I'd be more comfortable, but if they said low to mid single digits, I'm a little bit less comfortable with that. But all in all, this is a relatively small offering, and it gives you an opportunity to buy more shares at a discounted price. Now, I do have a few concerns about this equity raise. With all equity raises, it does mean that money is coming out of your pocket unless you don't mind the share dilution. So if you don't participate and everyone else does, then your relative ownership has actually dropped compared to everyone else. As you know, I am a dividend investor. I like money coming to me, not money going to the company, all right? And it doesn't really make sense when a company pays you dividends, but then asks for money back in terms of an equity raise. So all in all, it does incur a lot of fees, because as you've seen, $2 million here, it does add up to be quite a lot. Now, secondly, Oceania Healthcare had $175.3 million in debt facility headroom, so they could have easily used debt to fund this acquisition. So all in all, this acquisition was only around $77 million, so they could easily have used their debt facility. One of the reasons why I think management didn't use this debt is to actually, maintain that headroom in case of any emergency happening. If another Rona happens, then at least they have that headroom. But with this equity raising, it does come with a high cost. So as you know, the cost of equity most of the time, like 99% of the time, is higher than the cost of debt. So remember last year, Oceania Healthcare was able to raise $125 million in bonds at an interest rate of 2.3 or 2.5%, a very low interest rate. But now they're raising equity, and we all know that the cost of equity, the cost of having shareholders, is more expensive than having debt, because as shareholders, we do bear a lot of the risk involved. If the company goes bankrupt, we'll be the last to get paid out, and because of that, we do need a higher return on our investment. So by raising equity, they are actually increasing the cost of capital. And lastly, this could potentially signal the drying up of non-equity funding facilities. So as I've mentioned before, the company maybe have drawn way too much money out of their debt facility, and there's not much room for them to actually have that flexibility, which is potentially why the company decided to raise equity instead of raise debt. So these are my concerns with the equity raise. Now, in terms of the valuation of the company is currently trading at 16 times forward PE on the earnings of $55 million for the next 12 months based on my estimates. So at the moment, it does seem like, it's not expensive and it's not terribly cheap either. So personally, I will be applying for a very small parcel of Oceania shares under this offer. I also have very low cash reserves available at the moment. Personally, would have liked to participate in a larger chunk, but I'll still put in a small portion because I think Oceania Healthcare is a business that hasn't changed its business model. I think this company will still do well in the next 3 years, but at the moment, I think it's trading roughly at fair value, and there's not much short-term upside, but in the long term, the story still holds pretty well. So that's my take on Oceania Healthcare. Let me know in the comments down below if you own Oceania Healthcare, what you're doing about this capital raise. I'll always be keen to hear your thoughts. And if you enjoyed today's video, be sure to hit like and subscribe. But that's all for today's video. I thank you guys for watching this video. Until next time, take care.